Yo, yo, yo. Hey, guys. How's it going today? Hopefully it's a little better than yesterday. You can only lose so much in such a small amount of time, right? Looks like Bitcoin's popping a little bit. Looks like the market's getting just a wee bit better. We're waiting on Papa Powell. We should actually check over here and see if our Fed rate decision has officially occurred. Hey, Dirk, thanks for joining, man. Appreciate you. Oh, it looks like it's printing down here, guys. We got a little baby Fed rate decision. I'm going to say it's not a hike. If it's a hike, we're all fucked. I'm going to say not a hike. Not a hike. Let's see. How close are we? 1 minute. Blip in the matrix. Hey, Jesse. Is Fed even allowed to raise interest rates during an election year? Probably not. Yeah, and there's no need to. But I keep beating that, a lot. So I'm just going to take a break. Ahad, yo, Intelligent Computing, yo, Pacchio, thankful for you, man. Back at you, brother. All of you guys that help out with the channel, I really appreciate you. All right, we're still grinding. I'm willing to bet it's going to say 5.5%. And then we have the press conference. It's going to be coming up in a little bit. Maybe we'll look at some tickers in the meantime. I do have, if you look over here, I've got the last hour of the heat map for everything. So as the Fed talks here, we should start to see this turning green or red to get an indication of how markets are going. So we'll have some fun with that. J Powell Show. Yep, it's the J Powell Show. We're here for the show. Majid, thank you, Jesse. You are very welcome, my friend. And we got a little bit of time, guys, too. Oh, is it me or is Jesse's volume low? Is my volume low? Why do people keep saying that lately? What is going on? I'm going to squeeze in just a little bit here. I'm going to turn up. I'm going to try and turn it up. There we go. That's 55 dB. I can't get much louder. Can you guys hear me all right? Let me refresh over here, see what our Fed rate decision is at. Yes, it's a bit low. It should be higher now. I'm like 55 dB. It's pretty high. I'll put it up to 60. Oh, my wife just brought me coffee. 1 second. 1 second. Coffee? Gotta have the coffee. Gotta have the coffee. Very important. All right. Still waiting on the Fed rate decision. Should be happening right now. I'm going to say it's flat. Flat. Let's go back here. Look at projections here too. I'm not Starbucks. It's not Starbucks. Yes, it's a bit better now. Add gain. I'm at 60. Can't add anymore. Akash 2000. Thank you for joining, my friend. It's decaf. I just like to remind myself of back when I used to be able to drink coffee. So I'm much lamer now. I give myself a little bit of caffeine every once in a while. If hike SPY puts income. Oh, if it was it won't be a hike. But if it was a hike, you would watch a market collapse like you've never seen before. I mean, unless you guys were a part of the 2008. That would be it. Rate unchanged. Yeah, figures. That's a no-brainer, right? It's what the real question is, what is Papa Powell going to say? My guess is that he's dovish. Rate unchanged. There we go. There's our decision. Let's see if we have any further updates here. I need to figure out, if you guys know where I could get better levels of detail for the Fed rate decision, let me know. I'm going to see if I can find some real quick here too. I'll keep chat open. Fed rate decision details. Maybe I can get it from Ortex or one of these other sites that I'm using. Paying for all this really expensive stuff. It's got to be worth something, right? Let's see here. Oh, look at that. Starbucks too. Poor company. Fucking toast. Did you guys see Jim Cramer talking about Starbucks interviewing the CEO? He basically said he doesn't even know if he has a viable business anymore. It was pretty wild. Bad decision. See, is there anything I can get from this? It's more stock lookup. Let me see over here. Stock stamps, stock movers, portfolio, ownership, trading signals, index, credit default swaps. We don't need credit default swaps right now. Heat maps, analysts, insiders, blah, 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 blah. Nothing good there. What'd you say? Oh, wow, you mean Anthony Hopkins? Yeah. Anthony Hopkins had a bad fucking day today on CNBC. He got utterly shit on by Jim Cramer. I should see if I could find that. That was actually pretty entertaining. Let me see what I can do here real quick. I pay for CNBC Pro, I think, too. I've got all this stuff. I need to figure out what I want to keep and what I don't. Let me see. CNBC Pro. I pay for this trash. I've used it like twice. Let's see here. I'll try and pull that up. It says start a free trial. I've got one. Just log me in. You are now signed in. Okay, great. Then why am I still at a start a free trial? All right, 1 second. CNBC.com. Pro. Let's see. I gotta show you guys this. It's so great. What is this? This is so retarded already. Ah, here we go. Here, maybe we'll pull this up real quick. We'll listen to one of my favorite ranters on CNBC. 1 second.
$118 billion now to service the debt, on its way to $1 trillion, and we're at $34 trillion in debt in the U.S. We're $312 trillion debt in the globe. To me, the big feature here is sticky inflation is going to meet rising debt levels, and it's going to leave the government very little wherewithal to jockey around discretionary spending. And this all comes at a time where I know we're cutting back down to $25 billion on runoff, and also, like in Poltergeist, they're back. Buybacks are back. That was part of the Treasury announcement today. So we have QT ramping down, buybacks moving up, even though we're not easing. It's been voiced as a liquidity issue. I'm not sure. Liquidity issue really seems to be synonymous lately with rates going up quickly, but maybe they're going up quickly because spending's going up quickly.
All right, Rick, thanks very much.
I love Rick.
To those thoughts in just a minute. Bob.
I love Rick. He's one of my favorites. He's so great. He just goes off all the fucking time. Oh, let's listen to the panel.
Key sentence here is in recent months, there's been a lack of further progress toward the committee's 2% inflation objective. There's the higher for longer. And the issue is, are rates sufficiently restrictive to keep bringing down inflation? That's what we're not sure of. The bond market seems to think that there might be higher rates coming. The stock market, I can tell you, is very afraid of that. Remember what happened last year when the 10-year moved towards 5% in October? The stock market fell apart. We're at 4.6. Heading towards 4.7.
Yeah, the Bitcoin chart, it's not looking bad.
It's not positioned for a 5% 10-year yield right now. So that's a great fear. To the extent that they did not put...
We're at 58K now in Bitcoin. It's popping.
That's a positive read right now. Broader term...
Did people really think that rates were going to be fucking raised today? Is that possible?
Disinflation is not...
Is it possible people thought that?
Or is there a slowdown in growth? People are a little spooked by these earnings reports from McDonald's, Starbucks about a slowing consumer. My own sense is the low-end consumer is having a hard time. The higher-end consumer is not at all. So right now, I'd be much more concerned about the inflation outlook than I would be any slowing with the consumer. Guys?
So, Kristen, Rick, let's slip the word. I know it was in.
All right, real quick. You could see NVIDIA starting to take off. You could see some of this down here turning green if you guys are looking in the bottom corner. And that includes Bitcoin, too. It got up to 58 for a second. So I guess there were people that thought we were actually going to raise rates today. That kind of blows my mind. Let's listen to what the rest of these yahoos have to say.
It was intentional, very intentional. A word that has been in my head for some weeks now, and that is stagflation. Is that where we are right now?
I think it's too soon. I think we have to go back to looking at the second half of 2023 and the data that we had. So when we see the third quarter and the fourth quarter, we had really strong GDP. We also saw disinflationary forces that were really, really strong and better than anticipated. Q1, you saw a little bit of normalization, right? So you saw inflation not coming down, CPI certainly not where we wanted it to be for Q1, but I would call that more normalization. Even the GDP print that we saw that came in below expectations, when you factor out imports and you factor out inventories, all of a sudden it looks like a pretty solid GDP print. So I think this Q1 was about normalization, and the data in Q2 really matters for the Fed's trajectory from here and the overall economic backdrop.
Jim Caron, the fall off or the runoff from $60 billion a month to $25 billion may have been a little bigger than some people expected. React to that, and what in a practical sense does that mean to the markets and to consumers and the general public?
Well, look, I mean,
Hey guys, one sec. I'm trying something on my screen here. I don't know if it's going to get weird. 1 second. No, I'm not going to hit that button. No, I don't want to break it. Never mind.
I think Rick summed it up. There isn't much of a move in the rates market right now, and I think that's exactly what we should be focusing on. We're anticipating that the Fed's balance sheet is going to adjust, and I also think that a big balance sheet is a form of easy policy, so I think this does need to adjust over time. But Tyler, let me go back to what I said before, which is that this is really about resetting the clock for the Fed. When do they start to get confidence that they can actually start to cut rates? And this is the debate that's in the market at this point. So the debate is whether or not they, if you go by market pricing, is the first cut in December, or many forecasters still think July. And I think the fly in the ointment is going to be the labor report. If the labor markets start to weaken, I think that advances the time scale for the Fed to start to cut early.
Real quick, guys. Remember how I told you we were going to test the 200 moving average? I actually did a post earlier today that said that we could test down into the low 70s. Oil is plummeting. It's at 78.88 right now. So there goes all that inflation. Remember when I said left shoulder, head, right shoulder, go down? We could be testing the 100 here soon in the 77 range.
Earlier, but if the labor market stays strong, I think that they're going to stay on hold probably until December.
All right, so Steve Leishman, let me just get any further thoughts that you might have, having a little more time to read the statement and pull your thoughts together.
Well, I have a hard time seeing this as stagflation or in any way, shape, or form. Stagflation.
All right, we want to hear what Steve has to say because I think he's right. But also, U.S. government bonds, the 2-year, underneath 5 now. So we're dropping on that too. So it's always darkest right before the dawn.
Is high unemployment. It's high inflation. It's no growth. We are so far from any one of those three. Not that it couldn't happen, but stagflation assumes something is sort of broken in the price mechanism in the economy. And what would be broken there would be that if you do have weaker growth, prices would not adjust downward. We don't know if that's the case. I just think we're a very long way from stagflation. As for the Fed, I would say this statement reads to me like a plane that's circling. They're waiting for time. They've acknowledged there are a little bit of turbulence in the air there. They perhaps see some fog on the runway. So they're not quite ready to land yet, but I do think they want to land this plane. I think they're still on course to try and land the plane, Tyler. It's just that this is before the data either breaks towards weaker growth and lower prices, and or you get a move higher in inflation, which would engender a different kind of response from the Federal Reserve. But what the Fed is doing here is essentially holding.
David Kelly, let me get you to react to what Steve just said. Are we far away from stagflation? Are we nearer to it than might be comfortable for the Fed? What do you think, or is that really just not even on the table?
No, I think I completely agree with Steve. We're very far away from it. I mean, we've got unemployment below 4. We've got consumption deflator inflation below 3.
Hey, real quick, thank you for everybody who's here. If you could, real fast, if you could hit the like, just to show support for my channel, it would be greatly appreciated. Thank you.
3 plus 4 is 7, but 3 plus 4 is also good. These are good numbers for the U.S. economy. Growth is slowing, but it's slowing at a modest pace. So really, the economy is fine here. There's nothing wrong with the economy. It's just all a little too hot for financial markets who are banking on big rate cuts from the Federal Reserve this year. But even the statement, I think the one thing that strikes me is they could have cut the Treasury runoff from 60 to 30. The fact that they went that extra $5 billion, it probably doesn't sound like a lot, but it does say that they're trying to send a message here that they're not going to be too hawkish here. So if anything, I would regard this statement as being slightly on the dovish side, and it gives me more confidence that they won't hike again, but they will eventually cut rates this year.
I'm going to come back to all of you or several of you on a terminal question here about the terminal rate of interest rates. But Rick, let me just turn back to you for any reactions you have.
You know, to me, it's not that my sources or many people I have confidence in to gauge the future of the economy are saying stagflation's here. What they're saying is it's a rate of change argument. It's impossible to look at the GDP report and not say that growth is slowing, the rate of change is slower. So, yes, the economy's fine, but it's much less fine than they thought it would be. It's much less fine than the previous quarter. And if you looked at the pricing components in the last GDP report, inflation, the rate of change is moving back up. So it isn't that stagflation's here. It's that you can't put your head in the sand, okay? We had guidance from a dovish Fed that was very wrong, okay? Didn't hear much grumbling about that. But to have forward-looking notions regarding the glide path and rate of change of the economy that may point to stagflation, that to me makes sense, and I don't think we should ignore our eyes. Our eyes aren't lying. Things are slowing but still growing, and inflation stopped going down. You could call it anything you want, but what you can call it is a reason to ease.
How about what Rick just said? Who would like to react to that?
Well, I'll say something. Just
ahead,
briefly,
Bob.
just from the stock market's point of view, I cover the stock market here. The reason the S&P was down 4% in September
I'll get better at
because
that.
people were concerned that earnings or the economy were falling apart. The concern was higher for longer interest rates would bring down the multiple. So instead of 21 times forward
I was just saying thank you, Mitesh, for the tip.
earnings, we went down to 19 and change because higher for longer, of course, impacts the future stream of earnings or the perception of the future stream of earnings. Now, if there is some kind of slowdown in the economy, which we don't see yet, or the job market slows down, then the earnings numbers themselves are going to start coming down, and that's a whole other scenario.
Yeah, but Rick
The
says
S&P will
we
be in the
are seeing a
4,000s.
slowdown in the economy. Rick said you got to look at the numbers.
but
They are
Tyler-
slower.
Tyler, here's the thing.
jobs
Here-
numbers, which is what matters, are still pretty robust.
I'm going to let Steve
real
jump
quick.
in and then Jim. Steve, go ahead.
I'll keep it quick. The idea of that means stagnant. It means we're not growing. A slowing in the pace of growth is what we all have wanted. It is the soft landing scenario. So it would seem a little bit extreme to me to jump from we got the slowdown we wanted to the idea that the plane is stalling and about to crash land. Look, I think Rick is right. You got to factor that into your possibilities. I just don't think it's the most probable outcome because of what you expect to happen with prices in that scenario. In a scenario of stag, you get D, not inflation.
All right. Well said. Jim, I want to get your final thought, and then I'll go one more time to you, Kristen, and David. Jim?
So look, I think it's premature to talk about stagflation, but there's a lot of noise out there, so let's focus on the signal. Tyler, you were going to talk about the long-term terminal rate. I call that the forecastable horizon of Fed policy rates. What the market has been very stable on is that the market still believes that the Fed policy rate's going to 3.5% to 3.75% sometime by 2026. How we get there, how quickly we get there in 2024 and in 2025, there's going to be a lot of debate about that, and there's going to be a lot of noise. But what keeps the market stable, equities and fixed income, is if that longer-term forecastable rate stays stable. And right now it's staying stable despite all the confusion in the markets, and that is actually a blessing for asset prices at this point. If that rate moves higher, that could actually spell problems.
So that's where I wanted to end things. And that, Kristen, why don't I turn to you about that long-term terminal rate for interest rates. Jim just said 3.5, 3.75 by 2026. That's a little higher than we've been accustomed to over the past decade and a half, but maybe it's just not too hot, not too cold.
Exactly. I think it's higher than what we've experienced, certainly, and it's higher than what expectations are. I think since we've seen resilient growth, and I'm going to go back to something that Steve said, where we are seeing a decline in the growth rate. We're not seeing a contraction. We're seeing a slowdown in growth, which is exactly what the Fed wants to see, whether that's the data that we've seen in GDP, whether that's the data that we saw in JOLTS this morning. And so finding exactly what is that neutral rate and what is that balance is something that I think the Fed is going to take its time, and it's going to do it gradually in terms of the rate cuts that we'll see in 25 basis point increments, that if we get the data from an employment standpoint, we get the data from a disinflationary standpoint, we'll still see maybe even up to 3 cuts this year.
Mr. Kelly, you get the final word.
Okay, I do think the terminal rate ought to be higher because I think that 2.6% is too low for financial markets. But on the state of the economy, I know the numbers are getting a little worse on inflation temporarily, but that's kind of like saying, a teenager gets older every day. It doesn't make them old. And so this economy is really much more like a teenager than an 80-year-old right now. It's an economy which is showing.
All right, real quick. I'm just changing this. I'm trying to make sure that we can see what's going on with this color map. So I'm changing it to the 1 hour. It should make it to where we see the colors change a little bit quicker to green, red, black. But this is only the last hour. It's not for the day, okay? It's just letting us know how things are going with Powell.
Plenty of potential for growth. Inflation, I think, is still sticky, but probably trending down. Unemployment is very low. This is actually a pretty good economy for Main Street. Not quite as good for Wall Street if you really want short-term rates to come down to 2.5%. But frankly, I think this is a glass, not just half full. This is a glass about 80% full here.
All right.
Hey, thank you guys for the 600 plus people that are here. If you could hit the like, it's very supportive, and I really appreciate it.
All right, that wraps our conversation. Thanks to our panel. Lively conversation. We stirred the pot a little bit there. Thanks so much to all of you for your participation today. Really appreciate it. All right, coming up, we will get more reaction to the Fed leaving rates unchanged. We're going to get reaction to the Fed doing nothing. No, that's just a flippant way of saying it. We're minutes away from Jerome Powell's press conference. There, you will get a real chance to hear the thinking behind the Fed's actions today, or non-actions. We'll take you live, but first, a quick break.
All right, we're going to mute this real quick. Pop over here. Don't see anything going on with Papa Powell. So let's just take a look here and see what's going on with everything. We've got oil down 3% on the day. We've got Tesla down 1.35. We've got the U.S. government bonds down 0.62. Actually, I'm going to switch over and do something a little bit different. We're just going to pull up the watch list. We'll sort it by this. So let's see. Percentage change on the day. Starbucks, the absolute loser of the day today. Square, not so close second. AMD, brutalized. Nvidia, taking a decent hit. So a lot of stuff getting hit today, guys. Even PayPal, down 2.7. I think it was down 3.5 a little bit ago. You're very loud compared to the audio. Is that better? Is that still high? Let me do this. 1 second. Getting mixed messages here. All right, let me try that. Is that closer to balance? Let me know, guys. Yeah, I wish I still had them too. I called this fucking play on Starbucks so well, but I was too early, just like PayPal. And I said it was going to be China numbers that were going to crush us. And that's what started to happen this quarter, and that's why they're down 17.5%. A little low now. Okay. All right. You guys got to make up your damn minds. Figure it out, people. All right. We're going to go with that. I'm going to go with that. We're sticking with that. All right. So, but yeah, a lot of stuff getting hit today. Just a lot of interesting data. I want to jump real quick. Let's take a look. Make sure we're not missing Papa Powell. Papa Powell's still there. All right. Let's take a look at other stuff here. Let's just look at Bitcoin. That's always a good barometer on what's going on. You can see Bitcoin wants to bounce. And this is the same thing I drew yesterday, okay? I haven't changed this. This was in my post. So I said this is our zone, right? And I'll zoom back a little bit so you can see why. Maybe right about there. You can see that volume shelf right there. It's acting as support. So we could overshoot the trade range. But now that we're doing that, if I just draw this all the way down and then tidy this up a little bit, bring this back up to here. I mean, maybe even to there. But the thing now we're looking at a falling, broadening wedge, and eventually that wants to turn bullish. So one way or the other, guys, this thing's gonna want to bounce. Copycat, hey, thanks for joining, man. Appreciate all you guys that join. If you do join, it's $2.99 a month. Next month, I'm actually gonna lower it to $1.99 because I want more people to be in. I just don't want dipshits in the comment, and I feel like if anybody's paying, even if it's a super small amount, they're not going to be, or there's less of a likelihood they're going to be a dipshit. So that's why there's a fee at all, really. And I make members only videos for investments that I think do well. A recent one that did well was Matterport. Some people made from between like 130 to 1,000% in gains when they got bought out. That was a pretty good one. And then Tesla more recently. ARKG is fucking cheap. Yeah, I hope so. I hope it's fucking cheap. It is bouncing today. I saw that. Let's see. No Papa Powell yet. Oh, wait. What are we doing here? You're not Powell. Get the fuck off there. Oh, these guys are talking. Let's see what they have to say. Then we'll keep an eye out.
Up, and so it may be a low probability that we get to stagflation, but you can't dismiss it out of hand.
No, listen, Tyler, there was a lot of ifs and maybes that our guests put forth, okay? Maybe this will happen. I'm a numbers guy, okay? I look at the numbers, the hard data. GDP in the first quarter was 1.6. In the fourth quarter last year, it was 3.4. That is much slower. And if our guests say, well, wow, 3.4 was too strong, I understand that. But what was the consensus call? 2.5%. We got 1.6. I'm a numbers guy. That's slowing. And if we look at the GDP price index, it was 3.1. Okay? Last look, it was 1.6. And the core was 3.7 versus 2%. There is no denying the hard numbers. Now, we could question whether the numbers the government puts forth are accurate, and many who look at the labor markets don't think it is. But I will go with the numbers. I don't like changing midstream. So it could be a consensus call that stagflation's a low probability, but it's a significantly higher probability than it was a month ago and much more significantly higher than it was a year ago. And once again, the guidance from the Fed has been very wrong. People want to blame the markets. You could say dot plots. You can point to anything you want. But even the Fed chief Powell has had a lean towards move. They still have a lean. The question isn't.
Rick is so great. If there's anybody that's a better ranter than me, it's going to be Rick Santelli from CNBC. That man is a fucking legend. You should have seen him during the great financial crisis. He was the bomb diggity to listen to. Hey, Spencer O'Brien, thank you very much for joining. Yeah, so here's the deal. Monday through Friday, I do a market recap. I cover my portfolio. I show you guys the allocations. I show you the trades I did for the day. I show you if I was making money, if I was losing money. I'm very open and honest with all the stuff that I do for good and bad. And then at the same time, we talk macro. We look at economic and news events of the day, and we talk through those. And I give you my take on it, and I try and make it to where I speak to you like you're a fucking human being instead of using a bunch of complicated words in conjunction with each other in order to be able to make myself sound smart. So if you guys want to be a part of that Monday through Friday, if you're a starter pack member, you can get one stock request, and I'll pull up the financials and the technicals in TradingView, and we'll talk about both, and I'll give you my idea of if it's over or undervalued or if it's a worthy investment, and we can chat about it if you want to talk about it. Papa Powell is not up yet. And then on the weekend, too, on Sunday, I give, I call it like, I don't know, weekend update or something. That's probably what I should call it. But I basically on Sunday around 5, 6 o'clock in the afternoon, I talk about what happened over the weekend so that you're not missing anything before Monday comes around. And again, near the end of these sessions, I talk about stocks. I go through my stuff, and then I pull up ones at your guys' request. And if you're a starter pack, you get at least one. Sometimes I don't make it through the whole list. And then, but if you're an alpha, you get 2. If you're a whale, you get 3. And some of you guys just, I think, contribute because you want to help the channel, and that's greatly appreciated. So let's get back to Rick Santelli and his rant and see where we're going.
Whether they're going to ease, it's that they're going to ease. Well, what if inflation goes to 4.5%? So I'm a hard numbers guy, and the numbers do not back up most of the conversations I hear.
Well, he will certainly be asked, won't he, in a few minutes' time, in about 8.
I like Rick when he turns red, when his face just turns red. That man will scream at you. It's pretty awesome.
8.5 minutes' time, he will certainly be asked whether there is a possibility that inflation resurges and he has to raise rates.
Hey, real quick, before he responds, I am watching for Papa Powell, so don't worry about that. Once he comes on stage, I'll let you know.
Yeah, that's not my base case. And to be frank, my base case isn't necessarily stagflation. But I think that if you have a runway long enough right now to consider all the moving parts, I cannot dismiss how debt is a growth killer. And it's not only domestic, it's global. And it's only going to get worse. Even the IMF's numbers have some global growth kicking up a little bit, potentially in the next 12 months. But if you look at their longer-term prognosis, debt is going to dwarf growth, and it's going to be like an anvil on top of the shoulders of growth.
Well, I worry, too, about the volume of debt that we've added to the economy, and now at higher interest rates, how much more we're having to pay to surface that debt. Let me come back, though, to the stagflation discussion that we had in the prior block. If I discerned from sort of that panel's discussion that it was that, well, yes, the economy is slowing, inflation may be sort of plateauing, but this is the soft land. This may be the soft landing that everybody was hoping for. How do you react to that?
You know, I just think it's too early to tell. I can't tell if we're going to have a soft landing. If we get a CPI that moves up significantly, soft landing could go out the window. And it isn't only about the soft landing, just your discussion about what the terminal rate needs to be. There's no way to really tell what the terminal rate needs to be. There's no way to tell what it will be. So some of these variables that are so intricate in plugging into the Fed's models are just assumptions, and we really don't know. And anybody who's looked at how many variables, the Wall Street Journal did a report on this. I forget how many variables are in the econometric model that the Fed uses, but there's a boatload. And I'm not saying that it isn't the best model on the planet. I'm just saying that we don't know how much air we're going to have, and a little bit of air in the marketplace has a huge distortion when you move 2, 3, 4, 5 quarters down the road.
Tell me I'm crazy, Rick, which many people are more than willing to do.
All right, yeah, if you look at the bottom left over here, guys, I've got the heat map. It's for the last hour. So it's showing us if people are getting happier or sad. So we should see going from like a gray to a green or to a red. So far, it's looking pretty green. Can't hate it.
But about this sort of...
And we're still waiting on Papa Powell.
...assertion. Neither the Fed nor the Fed futures market have been particularly good about predicting what's going to happen. The Fed was talking about transient inflation for a long time before they took the word transient out of the conversation. Now the Fed basically is saying, well, we're going to be ready to cut rates, but now maybe not.
Trueflation and the Fed are on very different pages. For the person who just asked, I mean, these are not remotely comparable to each other. Trueflation had inflation at a peak over 2% higher, 2.5% higher than what the Fed officially showed. And now Trueflation is much lower than what the official numbers are from the Fed.
Not so soon, not so fast. The market, similarly, last fall, thought there would be a lot more rate cuts coming this year than the market says today.
Congrats on everybody getting a bounce. I think we're going to see more of it, so I'm excited for you guys. And hey, to the 726 people here, if you could hit the like, that would be greatly appreciated. It helps support me, so I thank you guys.
Hey, so who's the good predictor here of either what the Fed is going to do, what inflation is going to do, what the economy is going to do?
You know, Tyler, if I tell you that the Chicago Cubs are going to have 3 pitchers that are going to win 30 games this year, you'd probably raise the chances of them going farther down the season and doing better potentially and making playoffs. Well, what if the pitchers don't win 30 games? See, here's the issue with those predictions, is that the market is listening to the Fed. The whole premise of Fed guidance is to guide the market by the nose, okay? And when you still have a huge balance sheet, when you're still tinkering with rates, how can the market actually rise to the occasion and accurately price risk? In my opinion, 4 weeks ago, you did not see an ease in today's Fed meeting. That's what the Fed contract is good for. And
all right, sorry to interrupt again, guys, but somebody just said this a second ago. If you hit the like button, it actually makes the markets go more green. I don't know if that's factually accurate, but I'm willing to find out. So if you want to try it.
Anybody who thinks that looking today is going to give you an accurate picture of July, Sep, Nova Ds, and Fed Fund futures, I think they're misguided. It really is for the next meeting and only when you get within 4 to 6 weeks. And if you look at that as the criteria, the contract's almost infallible. What we are looking for that contract to tell us is impossible, okay? And just because traders are putting their money there, it isn't that it's wrong. It's so the Fed is positioned them that way. And in addition, the Fed Fund futures contract and options in large...
All right, I don't know if you guys have noticed, but Rick's color of his skin is getting redder. So it could get entertaining.
Part may be a hedge, and the hedge doesn't necessarily give you the entire picture.
So what I'm hearing you say there
Sometimes I feel like Rick is like my old geriatric Jack Russell Terrier. She used to bark a lot, and now she's just like much more timid. And I feel like Rick's went that way too. It's kind of sad. I miss the old Rick.
Is that the market, in its predictive value is kind of like a long-range weather forecast. It's going to be a hell of a lot more accurate predicting what.
Patrick, thank you for joining.
What's going to happen tomorrow or a week from today, rather than what.
Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. That economic activity has continued to expand at a solid pace. Although GDP growth moderated
What's going to happen?
4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run as of June 1, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month.
A month or
the decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
From today, correct?
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
expectations are not anchored
or anchored
or anchored
stable roughly? Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Thanks for taking our questions, Chair Powell. I wonder, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer that question. That would include inflation expectations, and all the other data too. Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take, which would cause us to want to consider rate cuts. And those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the course.
Well, and could you just follow
to 2%? And
much better.
For sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
All right, sorry about that, guys. Next time, I'll just go straight to CNBC Pro. I pay for this, and I never fucking use it. It's way better.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent...
Licky Neeks, or Nikki Leaks. There we go. What? Backwards. Dyslexic.
Has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, you know, from down the road and look back and understand it better. You know, if you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, you know, what's causing this inflation, you know, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. And I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig Torres from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said
that was a great question from him.
We're more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis. It's become, we're now focusing, the other goal, the employment goal, now comes back in to focus. And so we are focusing on it. And that's how we think about that.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print is led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. I mean, the question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, so you've got more supply, but those people also come in and they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market. You see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And, are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott.
You were Nancy. Nancy, sorry. Hey, Chair.
Powell just said he's fine with wage inflation because we're not really caught up. I love that.
You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors.
I just want to say one thing. So we don't have the supply side problem anymore from China, right? Not being able to produce enough, not being able to ship enough. It's actually the exact opposite. They're shipping shit tons of everything at super low prices, which is disinflationary, just to be clear. So we have the opposite thing happening that shot inflation up quite a bit, along with all the fucking money printing. We're kind of doing the opposite. So it's going to table off.
Did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions.
Please ask about prices continuing to go up, because that's happening because of high rates.
How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent. And you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation. assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets, at least, have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So
that's a great question, by the way.
You're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it.
That's interesting. You just said it's priced in already, so that's probably a good thing.
And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have just.
I just wanted to say one thing. That's one great thing about living in America is the fact that we have all these different Fed agencies and they don't act in just one centralized order. So it's a little bit better than China. China, nobody wants to hear the truth. It's just, you need to hit this goal now.
Sense, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not, it's not, frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
I gotta say, that was pretty good. It wasn't bad at all. The fact that he doesn't care too much about, some considerations of inflation that we've been talking about recently is pretty awesome. I think specifically in regard to wage inflation, I think that's great And from what I'm seeing from today's meeting, it looks very promising, and I think the market's probably going to bounce off of it. Let me real quickly here just take a look at some. So we're going to look at a few different things. So Bitcoin obviously got a little bit of a bounce. It's right up in the green zone where I was hoping we would bounce. And so if we could stay in here, this is a really good sign. High volume on the bounce up here. We'll see if it maintains. Let's look at the rest of the markets. Oil down 2.74. Got a little bit of a bounce off this announcement, not too much. I love that the 2-year is underneath 5 now, and so it's dropped 1.45%. That's actually a decent tick on the 2-year bond. That really matters. That 5% level matters, and it would continue to draw markets down. And then Tesla up 0.43% on the day, looking pretty great. It did close just a little bit of daily gap here. Not all of it, but that's a good thing. Like it looks very resilient. I said this yesterday. It already looks like it wants to bounce higher. No complaints on the Tesla front. And then if you haven't heard, I'll cover this more in the market recap, but there's additional things going on with Tesla today that are looking good. I won't say any more than that. I don't want to clutter the feed. Now, PayPal down 1%. Not bad. It was down like 3.5, almost 4. So it's getting its bounce. And here's the best part of this whole thing. If we actually looked at this on the weekly time frame, let me just do that real quick, and then I'll just draw this out a little bit more. Now, again, it still looks ugly for the week. We'd like to close higher, right? We'd like to get above this fib level. It's going to be right around the 69 level. We would like to get right around that. But if you look here now, we've actually popped above this other resistance level. So we had a resistance level forever right here that turned green and found support. And now we had another one where we tried to break out, couldn't, came back down. And that's kind of a new level of resistance, almost a inverse head and shoulders or a cup and handle pattern. And it looks good. It looks like it wants to go higher. I would love to see it close in the green today. That would be a great signal. The S&P got a decent bounce. Lots of volume underneath of us. It looks like we're in a trade range here. I'd like to see us close in it. I wouldn't like to see us go much lower than we are right now. I'm going to have to replace my $300 keyboard. That's going to piss me off so bad. It's like typing things. All right, NASDAQ up 0.86%, 0.85. Again, a little bit of a volume shelf underneath of us. I'd like us to stay here. We're above the 100 moving average on the daily again. It just looks tight. It looks like a good breakout. Again, if I just remind you down here, we went into the oversold territory on the RSI, right? So we bounced perfectly off that right at the oversold level. And now it looks like we're finding support on this average here. And it's great. It's just a good sign. We just want to see continuation to get confirmation that we're bullish. And the dollar, weaker, 0.33%. Again, I've said for a while it's just going to trade sideways. It looks like it's doing it. And the Japanese yen weakening against, or I should say gaining strength against the dollar for a little bit there. We want to see this falling back down. So we want to see this trade down over here so that we're not breaking past the 1990 level. We just don't need to see the Japanese yen get weaker when they hold so much of our bonds. Now, MicroStrategy up 0.8% on the day. Perfect bounce off the 100 moving average. Again, these are just from a technical level. Look at this. The Russell, the small caps, right now bouncing perfectly off the 200 moving average on the weekly time frame. If it got above this fib again, that's just a great confirmation that we're headed a lot higher. And again, the NASDAQ 100 moving average on the daily, we bounced off of that. Kind of looks very similar to the S&P. These are just all really good signs that the market likes what they heard from Papa Powell today. And honestly, I liked it too. He took a very middle of the road approach and he talked down this concept of stagflation, right? He said, I don't see stagflation anywhere. I don't even know what people are talking about. So he said that wasn't a big deal. And he said wage inflation wasn't a big deal because wages actually still need to catch up in his opinion. So I don't know. Personally, myself, I thought today was great. And I think it gives us runway to keep going. And I love that the fact that oil right now is dropping, and the 2-year is dropping. I think that's a very positive sign. If oil got down to 77, you got to remember this thing was 130 plus, right? 130 plus, even back further, way over here on this time frame, right? Like 130 plus, and we're about half of our high. Where is all this inflation, guys? Where's the runaway inflation from the 70s when we were at 130 And now we're at like 79 and we could be at 77, 75. We could literally be 50% down here soon. Right now, what are we down? We're down 39% from the high in oil. How is that the frightening inflation that everybody should be fucking worried about? Can somebody tell me that shit? Can you tell me why we should be so frightened of inflation right now, resuming higher? There's so many things that we look at where it just doesn't scream any problems at all in regard to inflation. And so it just really makes me wonder. I am very excited. So here, for the rest of the week, and then we'll be done here because I got to get ready for the market recap eventually anyway. So Wednesday today, covered all the good stuff. You know what? I'll talk about these later. But tomorrow, Thursday, we have challenger job cuts, exports, imports, jobless claims, productivity, unit labor costs, factory orders, New York Treasury purchases for tips. There's a lot of stuff going on tomorrow. Logistics manager index. There's just a ton of shit going on tomorrow. Total vehicle sales should be interesting. So definitely be around for the market recap there. I've got to get ready for the next one here in a few minutes. Probably going to call it quits. This was a great meeting from Papa Powell. He said everything he needed to say. I think he was pretty spot on with his approach today too. I have no fucking complaints whatsoever. I think the market's going to bounce from here, and I think we'll talk about that more in the market recap. So love you guys. Thank you very much for being here. Let's do it again. Peace out.